So welcome everybody. As Professor Snob said, my name is Alfredo Martinez. I work at CBC Federal Credit Union and I kind of oversee the marketing and the community outreach there. Today what I have for you is individual investing and kind of talking about the options you have. But before we do that, I'm gonna ask you to hit a quick pause on your computer or laptop and then ask you to fill out the pre-survey. So go ahead and do that now and I'll give you a moment or so. I'm guessing if you're tuning back in that you have done that, and thank you so much. As Professor Snop said, or the last workshop, we talked about retirement accounts, employee-sponsored accounts specifically. So we went over 401ks, 403bs, and 457s. It looks like there's a popular demand. It seems like a lot of students are interested around individual investing, more solely about stocks. We'll talk about that. We'll talk about stocks today. We'll also talk about different options that you have. And so we have actually a few workshop goals that I have outlined for you today. What I plan to accomplish is teach you a little bit about individual investment, those options and its differences. I also want you to take away the importance of short-term and long-term preparation and become familiar with volatility and risk. There's a lot of lingo in the day trading world regarding stocks, so there's a lot of kind of catch up slash beginning steps. I'm not going to go into too much details into the terms and definitions. I'm going to try to provide an overview really about stocks and day trading so you can kind of have an idea of where to start, where to look, and kind of give you at the end of this workshop where you can go to kind of play around at really no cost. That said, you really can't talk about retirement and individual investing until certain elements have already been established. One of those topics is Social Security. If you tuned into the last presentation that I gave, we talked a little bit about Social Security, the reality of old age, and how that plays into retirement. So this may be a review for some of those, and if it's not, I'm going to just take a quick few minutes to talk about that. As you can see, there's figures and graphs on the left side of the screen, and you see Medicare Part B, prescription drugs, real estate tax, and heating and oil. As you can tell, over roughly a 17-year period, each of these costs have gone up. This is just really bringing the case that the cost of living has increasing, and so that means that it takes more dollars, more of your wallet share to kind of pay for these things. If you see on the right-hand side, average Social Security benefit is about $16,440. So what is Social Security? Social Security is when you hit your retirement age, you'll start collecting benefits from Uncle Sam, and you usually pay into this your entire life, and that's really how it works. However, $16,000 for a given year is really not enough to support you, let alone a family, in today's day and age. And on the flip side, the maximum Social Security benefit is about $32,000, which may seem a large sum of money, but in retrospect, on a 12-month period, it's not that much. The point here is that Social Security shouldn't be your only means of retirement. And before you begin investing, you got to ensure you have some level of security before you start investing in the stock market, for example. Quick little story, just so you know of the importance of this. If you were interested in going into a broker or a financial advisor, let's say you had $20,000 in your account and you say, hey, I would like to invest this. We have a fiduciary responsibility, which is just a fancy way of saying is that we kind of have to financially look after you, and we won't be able to take the full 20,000. In most cases, we'll only be able to take 10, about half, because we have to legally leave you with an amount that you can then use if you need to. Otherwise, it may be locked up in stocks or mutual funds, etc. Furthermore, as an interesting stat here, in 2000, 4 million senior citizens were working. Today, 9 million are. One can kind of lead to assume that can come from multiple reasonings, and one of them being is a lack of preparation. So it's very important that you start looking at, your retirement and also your options as you continue to move forward through your life. Although this doesn't directly tie into individual investing, it's an important piece of the conversation. And really, you have to have these kind of nets, these safety nets for yourself in place before you really start diving into individual investing. So usually people that are investing on a daily basis, like on a day trading app or through Charles Schwab. Most of these folks already have a 401k set up. They have their pensions or the retirement plan set aside, and they're kind of savvy when it comes to individual investing. So I just wanted to start that there. But let's jump right into it and see what the world of individual investing looks like. So before we go into stocks, the one thing that you will probably hear in your lifetime at some point is what you hear, these three letters, IRA, individual retirement account. There's quite a variety of options there in the market, but I wanted to get you guys started with a basic definition and introduce you to two types of retirement accounts that live out there. We have the Roth IRA and the traditional IRA, also known as a pre-tax, just different lingo there. But the definition on the left-hand side is, what is an individual retirement account? An individual retirement account is a tax advantage investing tool that individuals use to earmark funds for retirement savings. There are several types of IRAs. I have outlined two without going too specific and the tax implications of all the other ones. These are the more common ones that you'll probably run into at some point in your life. So why would somebody get an IRA, or what does it mean to be tax advantage investing tool? Well, really, Uncle Sam, very similarly with 401ks in our previous workshop, Uncle Sam, the United States government looks after you and says, hey, if you're going to be responsible, we're going to kind of give you some tax advantages for your retirement. On the right-hand side, as you see, we have what we call the Roth IRA. The Roth IRA is an interesting IRA where everything is you pay taxes up front, is the easiest way to describe it for you. So the contributions that you make, they get taxed, and then that amount goes in as a contribution. The tax benefits of it are what we call tax-free. Really what that means is when you get your distribution, taxation upon distribution is what we call it. So every time you contribute, you're going to pay taxes, and then the net amount will go into that contribution amount. So when you get to that age of retirement, everything has been taxed already. You get that sum, and it won't be taxed. As you could imagine, it's completely different with the traditional, also known as the pre-tax IRA. The tradition on the pre-tax IRA says, hey, I don't want to pay taxes right now. I'll pay it once I get to my retirement age. So for example, if you were enrolled in a traditional, also known as a pre-tax IRA, you wouldn't be paying up front. So every $60 that you would put, the $60 total would go in. However, that doesn't mean that you won't have to pay. You will pay, but you will pay upon distribution at the retirement age. There are benefits to doing Roth or traditional. It really depends on your stage of life. Hey, if you have the means right now where your disposable income is a little bit higher and you have that leniency, most advisors would say, hey, do the Roth IRA up till maybe till you hit that midpoint in your life, so that you can then take the benefit of not paying paying taxes up front. And that way, because you have that disposable income, you don't necessarily need the full amount. Whereas the traditional, it's going to get taxed as soon as you hit that retirement age. So if you think about the traditional is that once you hit the later stages of your life, if you need more of that disposable income, if you need every penny, you can kind of switch your IRA to a traditional, also known as a pre-tax IRA, that allows you to essentially take every penny of your pay period of that paycheck that you want. So there isn't a right or wrong here. It really comes down to is, how does this best fit my needs right now in this very moment? Like I mentioned in the previous slide before, some of these elements have to exist before you can start actually day trading, because you don't want to put your savings account, your retirement account on the stock market, because it's very volatile. And we'll talk about that. We'll talk about why. So I hope that the key takeaway about the individual retirement account is just another tool that you can use individually to manage your retirement account. If you use these retirement accounts, are usually found at your financial institutions, so banks, credit unions, and even some brokerage firms, depending on where you would like to go. Individual retirement accounts usually are included in a portfolio. It's usually one element of a portfolio. And so we're going to actually talk about several options you have, not just stocks, not just IRAs, other options that you have. And that's actually or I'm sorry, really quick, some key takeaways for the IRA. That's actually the next slide, jumping the gun there. Some key takeaways for the IRAs is that, once again, they're tax advantage investing tools for the individual. This really puts the power in your hands to take that retirement, and you have full control. Depending on your employment status, IRAs can be of various types, and they all have different tax liabilities. Once again, the tax implications are different, both Roth and traditional. It really just depends on what stage of life you are in. Another takeaway from the IRA is that if you withdraw an IRA before the age of 59 and a half, you're usually subject to an early withdrawal penalty of 10%. And that's federally mandated. That's the federal government. And furthermore, some states will even charge you a percentage if you pull before your retirement age. In California, it's 1%. So you would pay 10% of the amount that you pull, and then 1% on top of that for the state of California. Another takeaway is that there are income limitations for contributing to Roth IRAs and deducting contributions to traditional IRAs. That means that on any given year, you can only give a certain amount to your IRAs. You can only deposit or withdraw money. So it really depends on, what your disposable income looks like. If you have a successful career making money, I believe the limitations right now are roughly around 19,000. So in any given year, you can actually contribute about 19,000 to your IRA, and then they cap you at that. And when I say they cap you, I mean the federal government. Really what the reasoning behind that is if you were a multimillionaire and you wanted to kind of get the tax benefits of the individual retirement accounts, this is a way that kind of stops those folks that are on those top tier tax brackets from taking advantage of this. Rules regarding maximum contributions and income limits for IRAs change each year. And this is something very important that does change every year. And usually wherever you have your account, whether it be a bank or a credit union or a brokerage firm, they'll usually be pretty good about telling you, hey, the IRA contribution limits are changing, they're going up, they're going down, etc. And that allows you to plan for the following year to come. Hey, maybe if the contribution limit went up, I can now deposit more. Why would that be beneficial to you? Well, that's really because then you can take most advantage of the tax advantages of these IRA accounts and ultimately lead you to a better sense of, I guess, of peace as you hit those retirement ages in your later stages of life. Like I had mentioned a second ago, the IRA is just one component, one tool used in a brokerage firm or a credit union or a bank. And typically in a brokerage firm, they'll have a portfolio, which means the IRA will be only one option or one piece of the pie. And so what are the other pieces of the pie, and what does that look like? Well, we have what we call savings accounts, very similarly to what you see in banks. We have bonds, something that you can buy off the treasury. You can buy bonds off from the treasury. Mutual funds, which is a combination of all these things. ETFs, which electronic traded funds. And then we also have stocks, what we see in the stock market, the NASDAQ, what we see that's being traded daily. All these come with a level of risk. As you can imagine, your savings account at your bank or a credit union is typically low savings. Not low savings, low risk. Why is that the case? Why is the savings account low? Well, it's because it's not really being traded. It's not really being managed like in the stock market is. And all credit unions and all banks are insured up to $250,000, which means is that your money, if something were to happen, a natural disaster or an act of God, you're still federally insured, and that means that the risk is low. Very similarly with the bonds, if you purchase bonds from the U.S. Treasury, the risk is low as well because the United States government will pay you back. Usually it's in a long period of time. We call these treasury bills, also known as bonds, and the risk is low. And so a portfolio that's diversified ultimately lowers the risk and it mitigates any type of unsystematic risk in your portfolio. And that's really what day trading and managing a portfolio is about, is that you want to minimize as much risk as possible by putting your eggs in different baskets that will yield a return for you, as opposed to putting it all in the stock market. And that's kind of goes to the reason why I brought up Social Security and I brought up the IRA, is because you can't approach the stock market as, hey, I'm going to approach the stock market, I'm going to make millions, and that's going to be it for me. No, you got to have plan A, B, and C, and then stock markets is kind of plan D slash learning more about day trading. As you continue to move right, as you can tell, the mutual fund risk is on the medium and the stock market is high. Well, why is that the case? Well, there's no guarantee that you will be guaranteed your funds back. You actually may come out losing out of this. As you know, right now with the pandemic that we're currently existing, that you hear on the news, the stock market has crashed, or stock market has reached all-time lows since, a long time ago. And really what that comes down to is business slows down, as they're not operating, generating profit. And like, let's say you had stock in Home Depot, and Home Depot had to close all their stores, for example. Usually it would tank, and then most of the investments that you have would drop down 20, 30, 40%. And imagine those folks that have thousands, hundreds of thousands, even millions in stock. It's a pretty dramatic loss for these folks. And so that's really why the risk is high. I'm sure if any business students are tuning in, you typically associate risk with reward. The higher the risk, the higher potential for reward, but also means the higher the risk, the higher potential for losses. And that's really why you want to approach it carefully and have some of these elements already kind of established before you kind of dive into the stock market. And actually later in the presentation, I'm going to talk a little bit about what steps you need to take before you really start diving in, and what it looks like, and from an individual perspective, what you kind of have to have in place so you can have a little bit of fun and learn a little bit how this works. Continued about the diversifying portfolio and risk, a little bit more definitions right here. A savings account is just an account usually found at a bank or a credit union where you can set money aside. It's a really typically low returns because it's a lot more secure. The bank will give you a dividend rate. Right now, they're typically very low, anywhere from 0.5% to 1%. You may find some options out there for 2, 3, 4. It just really depends where you go and try to look for them. A bond, kind of like I was mentioning, the treasury bills, is essentially a loan to a corporation, city, organization, or government. In this case, we're talking about the individual. So the investor is usually paid interest on the principal, but the value of the bond generally rises and falls with market interest rates. So it's possible to lose money when selling a bond, but it's very uncommon and very low. They're usually considered less risky investments than stocks because you're going to get that guarantee from the treasury, essentially, and you will get your funds back. Depending on the amount is really dependent on the market, but generally you will come out winning there. Mutual funds are just, I mentioned earlier, professionally managed investment accounts, generally stocks or bonds. It's usually a combination of quite a few things, and that's why it kind of gives the name of the mutual fund. The risk is spread out over many investments, so mutual funds are generally considered less risky than investment than a single stock per se. And this is what we talk about, not putting all your eggs in one basket, right? If you have your eggs in different investment vehicles, and the opportunity for you to lose, if you lose in one area, then it's simply that area in itself. It's not the entire portfolio that's trending downward. Although one investment vehicle may not be performing, but your other 4, 5, 6 will, and that way you kind of mitigate your losses that way. Stocks, also known as shares, represents a piece of ownership in the company. You say you wanted to go buy a piece of stock of Apple. You're technically, you have that one share of Apple, which means that you're an owner, you have ownership of that. But that ownership is really represented by the amount of shares that you have. So if you only have one and there's 500 million stocks issued, then you're a very small owner, but you're still technically an owner. Stocks are considered the most risky investment of the options. Nevertheless, it's worth noting, even within its relatively risk investment class, some stocks are considered safer than others. So that's exactly right. One stock, maybe a stock of Apple is less risky than a stock of Home Depot. That really depends on quite a few other elements. How's the market looking? Are you timing the market right? What does the volatility rate look like? All this kind of investment jargon is really the first step of of understanding, stocks, and the education aspect needs to come first before you kind of start playing around. I'm gonna kind of give a little background story here. I have a couple friends right now that are investing, and they use this an app called Robinhood. Robinhood is kind of a day trader application for the smartphone, and they start you off, with the free share of stock, and you put money into it, and they've learned this way. My one of my buddies was up about $6,000-7,000, but because he wasn't expecting the pandemic to come along, and he actually lost all of that. Of course, he is responsible enough to have his other options. He has his individual retirement account, his 401k, and a savings. So he wasn't. So although that loss hurt, the point is that stocks can fluctuate, and in an event like this, no matter how risky or how safe the stock is, or you're being told how safe or risky it is, events like this can really alter the stock market, and ultimately, make for dramatic losses, but they can also make for dramatic gains. And so that's how you kind of want to think about it. Once again, another way to kind of look at it is in two types of investment vehicles. This is kind of through our financial advisor. He believes this is a good way to look at it. And the way we talk about it is a fixed versus variable rate investments. So what you start off with is with a principal on the left-hand side. On fixed rate investments, kind of like savings accounts and treasury bills / bonds, they're kind of guaranteed. Whereas the principal amount on variable rate investments can fluctuate. So a principal amount really just means that you're starting off with, maybe $1,000. So if you put $1,000 into a fixed rate investment account, they're kind of guaranteed. Whereas in a variable rate investment, it can fluctuate your principal amount. What does a return look like for a fixed rate investment? Well, it's usually known and typically lower than you would on a variable rate investment because it's fixed, it's kind of guaranteed. And like how I had mentioned, the investment on the return on a variable rate, it's unknown but can be potentially higher. So once again, you have this level of risk that will always be present. Do you choose to go with a fixed rate investment vehicle and get a lower return, but you know that it's at least a return and you'll be positive? Or are you at a point where you want to kind of invest in a variable rate investments and you're not sure how it perform, but you know that the potential is a lot higher? Some examples of fixed rate investments are CDs, certificate of deposits is what that stands for. And really what that means is that, hey, I'm going to put $1,000 in this account for 6 months at this given rate. And the risk is usually very low because it's secured, and usually the bank or credit union or brokerage firm will pay you out. Another example is the savings account, money markets, which is a savings account with check writing abilities. On the variable rate investment side, we have stocks, bonds, ETFs, exchange traded funds, and mutual funds. So once again, the element here, the key takeaway is that fixed rate investments are usually guaranteed. The return is usually low, and it's also known, and the examples are there for you. How do you use them and when to use them? Well, fixed rate investments are kind of short-term, low risk tolerance, so they need to keep your money safe. A lot of folks use this as an initial kind of savings account or initial individual retirement account. So folks would then put, say, $20,000 in a savings or a money market or a CD to make sure that they have at least that pool of money ready to use when and if needed. Variable rate investments, usually on a longer term. You won't use or need the money for several years, seeking high returnings and willing to accept fluctuations. And so this kind of goes to what I was saying a little bit earlier. You're really not going to be in the stock market until you have some of these kind of fixed rate investments already set for you, these safety nets. If you're investing in the stock market, that means that you're in a position in life where you can actually lose money. If it comes to that, you will be okay. You won't find yourself tied putting all your savings into a variable rate investment, and it wouldn't be a wise financial decision to do so. Furthermore, I wanted to talk a little bit about volatility and how that kind of increases as you assume risk. This is an investment spectrum kind of used to describe what the risk looks like over a period of time. On the left hand side, you see fixed investments, As you go down the line, you see variable investments, and then you see this curve. This curve starts with CDs, savings accounts, T-bills, and then goes into bonds and bond funds, continues to balance funds, and then stocks, stock funds, alternatives, and then he goes into speculative investment, commodities, and options. As you can tell, the curve that you see on the line continues to hit highs and lows and fluctuate as you continue to get away from fixed investments to variable investments. So once again, the key takeaway here is as you go down and you go into stocks, stock funds, and then other investment commodity options, the level of risk is grows continuously. And that means that your potential to earn is just as high, if not more, but you also have the potential to lose is also very much present. And that's really the way you want to see it, is you want to have a level of fixed investments set aside before you start playing with variable investments. I hope that makes sense to you guys. And what I have for you right here is really what this kind of investments look like over a 10-year period. We have three lines on this graph right here. We have 90-day T-bills, we have the U.S. government bonds, and then we have the 500 stocks. The blue line is the S&P 500 stocks with an investment of 10,000 over a 10-year period. Then the green is what you have is the 90-day T-bills, and then the orange is the government bonds. So as you could tell, the return on the highest return you see here is on the S&P 500 stocks at about a 28,881. Keep in mind that you're investing $10,000 here over a 10 period of time. And as you can tell, the line continuously increases and drops and spikes and drops, but the return is a lot higher in the stock market than it is on the 90-day T-bills, which gives you about a $136 profit over a 10 period time. It's virtually almost nothing. The U.S. government bonds gives you a little bit more, close to 4,500 on top of your initial investment. And lastly, the stocks have the highest return, almost doubling, tripling your investment. However, this graph really doesn't represent if you put 10,000 in the S&P 500 stocks, so this is what you will get. Really what it is, this is just a past performance and to kind of give you an indication of the level of return you can see over a 10 period of time. Not everybody who has funds right now is investing in the stock market, just like not everybody who has funds is investing in 90-day T-bills. The way you want to view these investment vehicles and how to use them is dependent on what stage of life you are in. Once again, this is kind of going to be the motif of the presentation, is that investments and individual investments are really dependent on your financial fitness. Are you in a position in life where you can invest and potentially lose funds? If not, then maybe the stock trading and day trading needs to be put on pause until these other elements exist, right? So once again, the key takeaway here is that the stock market usually has the highest returns, but that doesn't mean you can't get returns other ways. It may not be as high, but you're guaranteed, or the percentage of guarantee of funds is a lot higher with these lower risk investment vehicles. And this is kind of what I was getting back into. What stages of life do you typically have to be before you start day trading or individually trading on these accounts like Charles Schwab, E-Trader? Well, as you see on the left-hand side, this is tier 1, and this is what we call the tier 1 getting started. And this is really where you kind of introduce yourself to a financial consultant, a financial advisor. And really what you're trying to get is the education behind it so you can make the best decisions in your benefit. Usually there's tools and calculators. If you were to Google right now, stock market calculators and tools, they'll give you an idea through Yahoo Finance, Market Watch, all these other websites out there, kind of give you an idea of how things are trending, what they believe, and they usually give you at no cost their opinion as well. Most of this information is out there. Everything that I'm saying today in this presentation is public knowledge for the most part. And once you get past tier 1, you start becoming this kind of like a beginning investor. A lot of these kind of options that you have out there from these other websites or brokerage firms is they usually start digitally. They'll give you digital advice or what they call robo-advisor technology, offering you diversified portfolios. This is a good tool for those beginning investors to kind of familiarize themselves and kind of diversify their portfolio, and really just play around a little bit without putting too much skin in the game. As you continue to go through your life, the next stage is what we call the investor. This is where you're a little bit more savvy. You understand the process a little bit better, and you actually now have assets to your name. And really, what the investor is just you're basing your management of assets through a modularized plan. And what that means is that you're actually working with somebody at this point, a live person, to kind of help you get to the stages of life that you'd like to. Hey, do I want to have a $5,000 check every month by the time I retire? Things of that nature. These first three tiers are extremely important to understand and navigate it as best as you can, because this is where the education, this is where the experience is really being built, and the understanding the mechanics behind day trading, or I keep saying day trading to represent buying stocks, selling them, options, things of that nature. So definitely, if you're a beginner, if you're in the getting started tier one, or if you feel like you've already played a little bit tier two, or even if you're at tier three, it doesn't hurt back to try to get as much information and educate yourself on these kind of topics, and that way you can kind of make the best decisions for yourself. One key note that we have seen through the financial industry is that these first three tiers are extremely crucial as far as brokerage firms, potentially not looking out in the best interest of the consumer, meaning you. So what that means is that there's a lot of brokerage firms out there that will take a percentage, but manage your portfolio for you. And this is more of the knowledge on the back end of it. Um, some brokerage firms pay by commission, which means is that if they understand that this particular stock will perform just as much as this one will, but this stock may give the investor a little bit more. Things like that you kind of have to pay into, and these are the first three tiers, the first three kind of stages of investing that you really have to understand the process, because there are winners and losers in this, and in most cases the investors are typically consistently winning, whereas the person like you, if you go to a brokerage firm, may not win as frequently as they do. So definitely pay attention. The next three stages of life are identified as planning and investments, and then when you get to that kind of advanced level. So the planning stage is really for comprehensive planning. This is where you're gonna have to start paying into, maybe having somebody professionally manage, but look specific into details, where I want my funds to be placed. Right now, there's quite a few options, and I kind of highlighted one, which is the S&P 500. Essentially, what these investors is these brokerage firms, manage just BlackRock is one of the biggest investment firms, and they manage over $1 billion. And they manage all over the United States. And what they do is that they have a lot of these brokerage firms have models that they follow, and they kind of institute, and they kind of give these models back to their financial advisors to follow. So usually what this means is, in this planning tier 4, what they do is they kind of get you on board onto this a model that best works for you, that best works on your stage of life. And really that's where the fee for service planning starts coming in, because you're going to be getting that more personalized, more detailed planning, the investments that you would like to. Tier 5 is planning but investments. So this is where they kind of start also managing your assets. So if you own a home, if you have accounts elsewhere, if you have money, that kind of sitting around, what they'll do is not only manage your portfolio for you, but they'll also take assets from your home and try to maximize the possibility of your earnings through all your other assets. And this is the later stages of your life, where you're kind of already have funds, you already have assets, and maybe you don't necessarily know where to begin. And the interesting thing about all these 6 tiers is that somebody who can be at tier 1 may be 50 years old. You'd be surprised how many folks come into our credit union and say, hey, I just got this inheritance check. and this individual's maybe 60 years old, and they never really established these kind of these first few steps. And so they're starting at tier one, but they've already lived 60 years worth of their life. And so this isn't discriminatory against young people or old people. Everybody's starting point is completely different. And lastly, we have tier six, which is the advanced, which is the concierge financial services. And that's really saying is that you have a really good understanding of what you're doing. And this is, in this model, you're still working with somebody, but the level of detail, the level of oversight is lower and lower as you can make decisions on your own. And ultimately, this is kind of the place where you want to be, the place where you want to feel most comfortable is in the advanced tier. And really what that means is, like I said, is that you're at a point in your life where you quite understand the way that your money is working and the way it's being invested. And so that way you can kind of put your opinion and tie yourself into this. Like I said, this isn't the only way to kind of navigate your investing life, but this is an easy way to understand and an easy way to have that concept of how I'm gonna approach this. I really want to reiterate the first three steps, the first three tiers, which is the getting started, the beginning investor, and the investor. That's where a lot of your knowledge, a lot of your knowledge base is going to come from, is during these crucial first three stages. Is that this is going to really allow you to kind of set you for the next three stages of your life. So it's very, very important that you kind of take that away today, the getting started, the beginning investor, and the investor option that we have highlighted there for you. I understand that this is quite a lot of information, and I hope that this content is, it really resonates with you. But the key takeaway is that there's options and there's a lot of informations out there already for you to use. And this is for the DIYer. One popular website is called MarketWatch, and another one is called Yahoo Finance. A lot of these folks have all the information out there. You can go into Yahoo Finance and type in Home Depot, and it'll give you, their ROA, their ROI, all these kind of key figures that people use to make decisions on individual stocks. On the flip side, the MarketWatch website gives you a really good breakdown on how to manage these funds. It comes with a lot of financial education, which I highly recommend. You could literally make an entire class on, day trading in stocks and span over months. And the easiest way that I have found to get this knowledge and let it really sit and resonate with you is to jump in and do it yourself. The nice thing about MarketWatch is they actually have a game involved, and it's no cost. There's no subscription, nothing like that. And it's actually a game that you can play amongst your peers or even friends. I use this website many times and through education efforts to help understand, how the market works and how day trading works. So here's a call to action for you folks. If you're interested in investing in stocks and day trading, go to this website. And there's actually a free game that you can kind of start. And the fun thing is that you can send this game to as many email addresses as you want. They'll get a sign up. And essentially on a weekly basis, you guys will be competing against each other to see who's performing the best. You set all the parameters. Hey, we'll all start off with $10,000, fictional dollars, of course. So you actually don't have to spend any real money to learn. And the nice thing about it, and the very neat thing, is that it actually uses real time. It looks at the market in real time, and you're making decisions on real time, which allows you to kind of get that instant feedback from a daily basis. So if you make decisions one day, you can wake up the next day and see how that stock performed, and then you can kind of gauge. And after a week, you get compared with your peers or your friends and how well they did. And you can do this for as long as you want. Very popular tool, very easy way to learn. And Yahoo Finance is just another great resource. You can type in any publicly traded company on Yahoo Finance, and it'll give you a ton of information on them, which is the other important aspect, which is educating yourself and understanding, hey, does this company look like it's going to be succeeding in the next, maybe 5 years or 10 years, or depending on if you're looking at short-term gains versus long-term gains. Maybe if we know Apple's going to be pulling out a new product that's going to revolutionize the world once again, then maybe I should put my money there. And so there's a lot of information being traded online, and you can kind of learn there. That's really the best way to describe individual investing. It's really tough, and I have to be very careful in the way I address and how I speak about it, because this shouldn't be taken as advice or, hey, go out and trade and go learn. Really, what this is a source of education for you. This is a beginning step, depending on what level you are right now. My assumption is that since you're many students, and then when I was a college student, I wasn't as savvy as I am now regarding day trading, regarding stock trading or different investment accounts, things of that nature. So definitely take that time to really educate yourself so you can make the best decisions on your behalf. But as I mentioned before, the Market Watch game is completely free and doesn't take any of your real dollars to play, which is a very nice tool used. What we talked about today is that we hope that to learn about individual investment options and its differences, but also to understand the importance of short-term and long-term preparation. And that kind of goes back to the different tiers and different stages of life that we go through, is that you want to be able to prepare for the short-term and long-term. The short-term may be stocks, whereas the long-term may be an individual retirement account. It's really for you to decide, but how do you make the best decisions is through education and really understanding the process. We did go into a little bit about volatility, and risk. And really, the key takeaway there is that there will always be an element of risk that is actually going to be present. And if you have access to my previous workshop where we talked about 401ks, 403bs, and 457s, I also talk about those investment vehicles and the risk that's present there. And so the key takeaway with the risk in the stock market and how volatile things can be is that, as you know, in real time, the coronavirus has really affected the stock market and has launched us in a mild recession, or at least a down in the stocks in the market that we see. So definitely pay attention and listen out there. And I would actually encourage you and challenge you to talk to your parents, talk to your family members to see if any of them are day trading, or if any of them, what investment vehicles they are using, and use their experiences to pick and learn from. This is an easy way to also measure how prepared your family is. Maybe are they reliant on Social Security to be there for them? Maybe you need to be that proponent of change and say, hey, family, hey, close friend, I think we got to talk about, what my retirement's going to look like, how I plan to achieve some of these long-term goals that I have. And really, the sooner the better. And once again, I really encourage you, if you have the access to reach out and watch out the previous workshop, which is the 401ks, 403bs, and 457s, just because it's just as important information as what you're hearing right now, if not more important. That said, we got a workshop lined up coming up real soon, and we're actually going to be talking about different financial institutions. So I'm going to be covering the basics from credit unions to banks to online banks to e-lenders to different options out there. As you know, as the market evolves, we have so many options when it comes to, hey, where do I want my bank? Where do I want my checking account? Where do I want my savings account? So please tune in there. The last thing that I'm going to say today is that I want to thank you guys for tuning in, and I hope that these workshops have at least brought you some level of confidence and level of education to make you a little bit more prepared as you navigate your careers and your schooling as well. I hope that you take the pre-survey or the post-survey for Professor Snop and myself, so we can kind of better understand where we sit and what information you'd like to learn. And that feedback is extremely important, as it helps me outline my workshop goals, and it helps me prepare content for you that is meaningful and relatable, and most importantly, understandable. With that said, I'm going to switch it over to Professor Snop, and so let me do that really quick. Thank you.
Thank you, Alfredo. You shared quite a bit of information for the students, and I love the fact that you identified what had taken place within a 10-year period from 2009 to 2019. I know that we've seen tremendous growth in many of the products, and it certainly then explains what happens over time if things are ratcheting up in terms of investment value. I really appreciate that. And I really like the fact that you focused in on the different risk aspects for each. So you started with savings accounts on the left, low risk, and then you went up into other kinds of investment products all the way up to stock, which would then be more of a high risk investment. So it's really wonderful to see that there's this perhaps a balanced approach to all kinds of investments from the standpoint of what students can learn now and then what they can apply in real life as they start delving into investments like, you know, IRAs and other kinds of products that are available to them. So I really appreciate that. Thank you so much. So students, this is the second to the last workshop. As Alfredo mentioned, we have one more workshop to deliver, and that's the choice that you have currently, you and others in this world have in terms of banking. Who are you going to pick as your financial institution, and what are the products and services they offer? And I was really surprised when Alfredo pointed out that there could possibly be 3 or 4 different options you have right now, but you have to weigh the pros and cons with, is it convenient, and is it going to be convenient all the time in order to access your money and make investments and put things away for a rainy day kind of thing. So that will be the next workshop coming up. We really appreciate, Alfredo, what you have presented today, and look forward then to the next workshop coming up for financial literacy with first-year experienced students. Thank you so much for tuning in. Have a great day. Bye.
Bye.